How ridiculous is it that the entire economy lives or dies, moves and breathes based off of the carefully crafted words and phrases of a few ivory tower elites? I mean, this isn't the way that it's supposed to be. Just imagine if people and businesses, all they had to focus on was just growing your business. Just keep your head down, work hard, earn more, save more, invest wisely, do research, due diligence, well into your investments. Just as long as you do the right set of habits, you are going to succeed. Instead of this convoluted system that we have right now, where basically the entire system could come crumbling to its knees, is being actively destabilized by a few knobheads at the Fed. And that's what free markets are supposed to be. And anybody who thinks that this system that we have right now is free markets or capitalism is, well, they don't know what those words mean. So as we can see here from this article from Bloomberg, the recent Fed minutes from the Federal Reserve's July meeting were just released, and most of them see that they're going to start tapering by the end of this year. So what we are going to talk about here is basically, number one, what is tapering? Number two, what is it not? And number three, what's going to happen if and when the Federal Reserve decides to try tapering. So number one, what is tapering and what is it not? Well, number one, it's a purchase taper. So this is very different than a balance sheet taper, which I've talked about before. But back when they started quantitative tightening, the Federal Reserve's balance sheet was actively being drawn down. So they took assets that they held on their balance sheet and they were selling them. That was quantitative tightening. And so tapering, this isn't a balance sheet taper, this is an asset purchase taper. So right now they purchase $120 billion of assets per month, and that is mortgage-backed securities, and that is also treasuries, which is debt from the United States government. And so they're mostly in disagreement, it looks like. There's a widespread of opinion on timing, speed, and structure of the upcoming tapering. And so it looks like there's kind of consensus at the Fed that by the end of the year, they need to start tapering the asset purchases in some sense. And so maybe that means getting rid of the mortgage-backed security purchases and still purchasing $80 billion worth of treasuries every month, but just not purchasing the $40 billion worth of mortgage-backed securities. Maybe it means just a slow, 5% cut in the number of purchases per month. Maybe it means right now they're purchasing $120 billion minimum of assets. Maybe the $120 billion turns to a maximum. Maybe that's the cap instead of the floor. And so, and again, there the widespread of opinion on timing, it says as well. And so maybe it's a slow increase in how much, or slow decrease in how much they're purchasing, month after month or quarter after quarter. So most of them see a taper in the asset purchases. And so this is different than a balance sheet taper, where a balance sheet taper can't happen until their purchases hit zero and then their purchases turn into sales. Because right now, all of the purchases, that's just adding assets to their balance sheet. So you can't taper your balance sheet unless you've already brought your purchases to zero and then you start to sell. Keep in mind that when the Federal Reserve buys something out of the economy, whether that is a mortgage-backed security, whether that is a United States Treasury, what they are doing is they are adding money into circulation. They are increasing the money supply. And yes, that is done through the banking system, because they're not putting cash into a person's bank account. They're putting cash basically into the bank account that's held at the Federal Reserve, which allows the bank then to go and have more freedom to expand the money supply for individuals and companies. But ultimately, that's the purpose of it. That's why the Federal Reserve buys assets. It's to increase or keep the right amount of money, as far as they're concerned, in circulation. And so when they're buying assets, that's expanding the money supply, or that's a purpose behind it. It might not always work out exactly like that, but that's the intention there. And it's because they're pulling an asset out of the economy, but they're replacing it with cash, so that cash can then go and be multiplied into loans and other things. And when they start to taper their balance sheet, let's say they bring their purchases to zero and they start to sell things from their balance sheet, what they're doing is they're withdrawing cash money from the system because they're selling something. They're selling a bond back into the economy. In order for them to sell that, they have to accept cash for it. That means that the amount of money in circulation goes down. And so that's why easy monetary policies, asset purchases by the Fed, are inflationary because they're designed to boost the amount of money in the system. That's why tightening and reducing the size of the balance sheet is deflationary because it's actually withdrawing money from the system. And when the amount of money in the system contracts, that means all of the money relative to all of the stuff, all of the money becomes more valuable than all of the stuff, meaning that all that stuff becomes cheaper. You can get stuff for less amount of money because the money became more valuable relative to all the stuff. And so that is deflationary. Those are all just different ways of saying that's, saying deflation basically, price deflation. And that's assets, that's goods, that's services, that's wages, that's everything. And that is why last time the Federal Reserve tried to tighten and tried to reduce the size of their balance sheet, they couldn't. They tried it for a little bit and everything almost collapsed. Everything almost fell apart and they reversed it. And basically now we know QE infinity. The other thing that tapering is not, because now we know tapering, what they're talking about is an asset purchase taper, so lowering the amount of assets. It's not a balance sheet taper. The other thing that it's not is it's not a change in interest rates. The Federal Reserve right now only explicitly controls short-term interest rates, basically the Fed funds rate. They don't directly, and I know that they basically do control interest rates across. There's like a soft yield curve control happening right now through their asset purchases, but they don't outright target very specific ranges of interest rates for the whole entire bonds. They don't outright engage in yield curve control right now. And they only control the front end, the short-term rates. And so what they're trying to be very clear about here with this tapering that they are going to try to engage in allegedly by the end of the year is that this is not going to be an interest rate hike. They're going to keep interest rates down. And at the same time, they're going to lower their asset purchases. So what's going to happen if they do start to raise or if they do start to taper? Well, one thing that's going to happen is that interest rates will go up. I know that's kind of funny because I just said that they're not going to raise interest rates, but when you look at the 30-year, this chart right here that we're looking at is the interest rates for the 30-year Treasury. When you look at the 20-year, when you look at the 10-year, when you look at these longer term, anything that's not basically kind of considered basically used as money in the financial system, anything on the longer end of the curve, those rates are going to go up. There's no way around it because the only reason or the only way that interest rates are at the place that they're at right now is because they have a giant buyer, somebody who can print money and who doesn't care about profitability in the face of inflation, who is buying those bonds at their current yields. So if that buyer goes away, the bond prices have to drop. And if the bond prices drop, there's a direct correlation there. That bond prices dropping means that the interest rates go up. The other reason for that is because interest rates are negative right now. Real interest rates are negative. So when you take the interest rate of 1.26% on the 10-year, you adjust that for inflation, your real leftover return after considering the amount of inflation is negative. You're losing purchasing power. So the free markets don't do that. And the only way that interest rates can be at a rate that's lower than the rate of inflation is by artificially suppressing those rates by somebody purchasing enough of those bonds to purchase those or to push down those yields enough to where those interest rates are negative. And so if that buyer goes away, that means the only participants left are free market participants who do not want to lose money. That means prices will have to adjust for the expected return. You can't just put money into something with the knowledge that you're going to lose it. That's kind of idiotic. And so if the person or the buyer, the money printer, goes away, who's keeping those rates suppressed, the rest of the free market the equilibrium point for bond prices is a lot lower, which means equilibrium for the interest rates is a lot higher. And so that's one thing that will happen. Alongside that, maybe as a result of that, or coming just kind of like in tandem with that, is that markets will dump. Interest rates, let's take a look at the S&P 500 here. Since the bottom of 2020 to right now, basically we've had a straight line up. NASDAQ has been a little bit choppier. The Dow has been pretty similar. Russell 2000, we've been consolidating for basically the entire year now, just moving sideways. But essentially, the markets are only at the levels they are at because of the levels of the cost of money, the cost of debt, the interest rates right now. Corporate America is, I've said it over and over and over again, over leveraged. And that means if interest rates go up, whenever corporate America rolls over their debt, they just take off. That's rolling over your debt means you're using new debt to pay off your old debt. If interest rates go up, that new debt gets more expensive. So the only way to pay off that old debt is now from revenues or from just taking the hit and paying a higher interest rate on that new debt, which can only be supported by higher income. And the level of leverage in the stock market on corporate balance sheets is so high that if interest rates move substantially higher, there's a concern that many companies will be insolvent. You don't have the ability to sell as much, issue new shares in order to produce new cash that you need. That whole kind of money train starts to grind to a halt and it starts to reverse itself. And so you have this very dangerous game unfolding where if interest rates start to go up because of this taper, you start to have asset prices like equity prices fall, and those two things kind of feed on each other. Well, what will happen then if markets, before I move on from there, what will happen after that? So bond prices will dump, which means interest rates will skyrocket. The other thing is that equity markets will dump. And then the other thing that will happen is gold will bottom. So we've seen here, 1680 has been kind of the support and resistance for gold since really the beginning of 2020. We had a big run up after that, and then it's touched back down there multiple times since then in this giant consolidation for over a year now, as it's just been kind of continuing its slide downwards. Now, if we take a look just back a few years, we're going to see when gold bottomed back here at the end of 2015. Gold bottomed at the end of 2015 down here. Do you remember what happened at the end of 2015? Quantitative tightening. So for years after all of the easing, everybody kept on talking about at some point the Fed will tighten it, some point the Fed will tighten it, some point the Fed will tighten it. And every time people talked about that, every time expectations got closer and closer and closer, the gold dropped more and more and more. What was the event that happened right near the gold bottom? The tightening actually started. So this was a perfect buy the rumor, sell the fact, or sell the rumor, buy the fact type of situation here. That by the time it begun, what was supposed to be negative for gold, that was actually the bottom, and the only thing gold has done since then is go up. Similarly, right now, gold skyrocketed on the news that the Federal Reserve was printing a ton of money. The money supply was expanding. Inflation was going to happen. And since then, really all that's happened is in the realm of gold pricing regarding economic action is fears of future tapering. Fears of what's going to happen when the Fed stops the gravy train. Well, once they stop the gravy train, we're seeing a very similar setup to the end of 2015, beginning of 2016, where that will be the event that will mark the bottom. Maybe it falls a little bit below 1680, puts in a false breakthrough there, and comes back down a little bit, 1640 or so, as we continue down this, this trend here that we've been following along very closely for over a year now. And if that happens, then by the time that they actually start tapering at the end of this year, all the fears of that tapering will have been priced in already, and the bottom will be put in. So it's not a prediction. It's just these are, very similar things that are unfolding right now. And I'm by far not the only one who's noticing this or pointing this out. Many other people are talking about this as well. So I'm not claiming that this is something that I just, noticed all on my own. And so it does look very promising here, in my opinion, for gold. That the closer we get to tapering, and if the Federal Reserve actually it starts tapering, that will mark the bottom in this over a year-long downtrend in gold now. All right, so then the last thing that will happen if they start tapering their asset purchases is a reversal, because if we see the stock market tank and we see the bond market tank and interest rates skyrocket, that will mark when the Federal Reserve decides to reverse their course and start QE up again. Not up again, but start purchasing more than they were before even. Because take a look at this tweet by Sven Henrik at Northman Trader on Twitter. Every time there's been a 20% or larger drop in the market since 2009, the Fed has either changed their policy or reacted with new intervention. And he posted this nice little chart where he marked every single time that has happened and what the policy response was. And at this point, with the fact that we've had, this massive run-up in equity markets, specifically as a result of all of that new money injected into the economy that's had nowhere to go but bid up asset prices, when that starts to pull back, the opposite will happen or in equity markets as well. And so if we do see a 10% drop, a 20% drop, we're going to see the Federal Reserve, as fast as they slightly reduce their asset purchases, jack that thing up and bring it to $150 billion or $200 billion worth of asset purchases a month, because the last thing they want to do is trigger a deflationary collapse. They are much more comfortable with the fire, playing with fire, the hyperinflationary fire, getting very close to that, than they are comfortable with getting close at all to anything resembling deflation at all. So that's my take here, and even though they're talking about it, I'm highly skeptical they'll ever actually start tapering their asset purchases. But if they do, I think interest rates will start to skyrocket across the board. I think equity markets will start to drop across the board. Gold will put in a bottom, and very quickly they'll reverse course. So that's what I'm looking at, and hopefully that is helpful. We shall see what they end up doing by the end of the year. But as I've said multiple times, it's all one trade now. Everything lives or dies, moves and breathes based off of the very carefully crafted words and phrases of just a few ivory tower elites. And that's the world that we live in. And so trade and invest accordingly. As always, thank you so much for watching. You guys have a great day.